Here's how to profit when the market is falling. Take a look at this trade. Back on August 26th, the market had started falling after being in overbought territory. That's a great time to buy puts on bad stocks to profit, protect stocks you already own, or buy puts on a major index to protect your whole portfolio. Here's what that looks like. You could buy puts on the Qs, which tracks the NASDAQ, or you could use other index ETFs like SPY, IWM, or DIA. The Qs were at 307 that day. Buying a slightly in-the-money put option about 60 to 90 days out would cost about $1,700 per contract. As the market fell over the next month, your insurance policy gained $2,400. That's a return of 137% in 1 month. To learn how to use calls and puts to profit in both up and down markets, register for my next free training webinar at VectorVest.com/OJS webinar.